Well, people, it looks like the media is back at it again with the soft landing narrative. Just a quick search on the Bloomberg terminal, James Lavish pointed out there's a bunch of articles being written. Another interesting chart that depicted this was looking at the number of articles mentioning soft landings, putting it close to the gray shaded areas, the U.S. recessions. And what you'll see here is optimism tends to peak before downturn hits. This was in 1999 going into 2000, and then also right there prior to the great financial crisis. And, well, we're talking a lot more about soft landings at this moment. You're starting to see things from Nick Timrose from the Wall Street Journal. He had mentioned today that Eric Rosengren says a soft landing is now his base case. Goldman Sachs also came out with an article about soft landing. The U.S. economy is on its final descent, so everything just seems just so well. Unfortunately, Walmart actually expects to see a period of deflation in coming months if you listen to that earnings call, and same with Target, signaling a halt to revenge spending and delays in impulse buys. We got a lot to talk about on today's Stock Market Brief, show where we navigate the financial markets through the lens of technical and intermarket analysis. If you haven't done so, make sure to hit that thumbs up. It is greatly appreciated. Subscribe to the channel if you haven't done so already. This show is brought to you by my Patrons. They're the ones that support this. Remember, I do all of these videos for absolutely free on YouTube. And then if you want some additional content, some cool trading bots over here, through Trade2X, I activated their entire Discord service. I give my watch list with a tight list, which is really cool. I got to talk about it another day. I do daily, weekly, monthly expected moves. I give zones, which is a cool indicator. Spreadsheet that I put out. I give my stock market indicators, educational videos there. Those are from my YouTube channel, so they're free on my channel. I'm just organizing them there. And then you get access, obviously, to the community and whatever they want to be talking about. That's all for $9 a month, so make sure to check it out. Also, my partner, Interactive Brokers. Click the link down there below. Check out their Interactive Broker Campus, where they offer a bunch of free educational content. Let's get into today's episode. All right, people, welcome back to the show. A couple other interesting charts before we get into some of the technical ones over here posted by the Market Ear. This is the Goldman Sachs U.S. Financial Conditions Index. When the line goes up, it's when financial conditions are tightening, which is typically bad for the overall market. And as of recently, we saw a massive drop in financial conditions. And, well, that led to a pretty large market rally. They also posted this side-by-side analysis of the 2023 NASDAQ 100 and the 1999 in the green line. They're saying, are we gearing up for a big melt up? Of course, that's going to be the talk right now, right? All this optimism. U.S. money market funds assets climbed to a record $5.7 trillion. And this is interesting to me because this is the stock market's competitor right here. People are putting into very low risk, if not no risk, funds and making about 5.5% a year on their money. Now, if they decide to flip out of this and start pushing into the stock market, well, that could very well be the next fuel for the fire of a large move. Goldman Sachs also said that top book liquidity has doubled from 8 million to 16 million. Boom. Month to date. That ability to transfer risk has increased. They expect liquidity to tick lower heading into Thanksgiving. When liquidity is lower or drying up, it typically means the market is much more volatile. Taking a look at the price of oil, this was a large move in the price of oil today, and many people are saying this is signaling a recession. We'll talk about that because it could kind of be a couple of things here, right? Down 4.66% on the day, down 25% from that September peak over there. So obviously a large move down in the price of oil. Now, this could be just an unwind, right, of the geopolitical risks, perhaps. Or maybe perhaps it is signaling a recession. I'd say if we start getting below 65, maybe that could be a demand problem. So we'll continue to watch that. Now, if I show you this chart, this is what I do find really interesting. If you look at a monthly chart of oil and you apply a 12 month rate of change, so it's a yearly rate of change, all large spikes typically happen and then that precedes a recession. So like in 1987, we saw this huge massive rate of change in the price of oil. 1990, the dot-com, the financial crisis, and then even the 2022 bear market. Saw that large spike up there, and this is something we've been paying attention to. And now as the rate of change dies off, that's typically where we have that signaling a recession. And what we're seeing now is obviously oil price coming back down. We've had the bear market, right? In 2022, we got some relief as of recently in the stock market. We will see here if this chart is going to tell us, or it's giving us insight into the potential future. If you take a look at copper still hasn't really caught much of a bid. We bounced up a little bit, but yet still S&P 500 moves up higher, so it's kind of diverging from the S&P 500. And this is also an economics sensitive commodity, and we're putting in a high, lower 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 high right here. So we are coiling up, potentially getting ready for a move. Are we going to be breaking out, heading higher, or is this going to potentially break down, which could be bad? If we take a look at the dollar is also still holding relatively well. We had that big down day on CPI, but we're kind of bouncing back. That's happened before, where we followed through back down to the downside. Now, being that the dollar is up a couple of days, it is interesting to see gold also up in correlation with that. So if the dollar continues to drive lower, this could really send gold off like a rocket ship. But as it stands right now, gold is actually in correlation in a shorter time frame with the dollar. If we take a look at silver's been up pretty massively these last 3 days. The silver chart is the red and green candles. I apply the GDX, that's the black candles, right next to it. And the reason why is because I just want to point out the tight correlation here. When the silver kind of goes up, you can see also miners go up. So silver, if you want more beta than gold, you can look towards silver. There's typically a good correlation. If you want more beta than silver, you can look towards miners, various miners, right? Obviously, you got to understand if volatility picks up, these things, can get hit too as well. But you can see they bounced up pretty well these last few trading days along with the price of silver. If you take a look at Bitcoin to gold ratio, the Saylor to Schiff tool, this is coming off slightly here, but still well above the zero line, which is a positive sign. Now, if you don't know what the Saylor to Schiff tool is, this is an indicator that I put together a while ago and shared it on YouTube, showed you how to make it, show how the strategy that I use behind it. The last buy signal was right over here, and we started ripping up higher. Now it's starting to coming off. So when we get a close below that, I will notify the group and put that on here on YouTube, just to be aware, because these have acted as pretty large sell-offs in the price of Bitcoin, and that could also mean various other crypto assets too as well, including crypto equities. All right, if we take a look at the 10-year yield, this is going to be obviously the important asset to watch. This has a big, intermarket relation with the overall markets. And we had that head and shoulders pattern. We bounced up just the other day. Well, we fell back down today. Bond volatility is obviously still remaining high. A measured move would bring us down to 4% to 4.1%, just to reiterate what we previously discussed yesterday. So we'll see here how much further this can drop. Even if it comes down here, just be aware that we're still, up since April, putting in higher lows and higher highs as it stands currently. But we did recently break down through that channel and the neckline of that head and shoulders pattern. If we take a look at the 10-year note futures, the CTA buy trigger is right over here at about 110, and then the other one is at 1114. So this inverse head and shoulders here, if we start getting above this line, could send us higher, which would bring us to that measured move, potentially even lower to around 3.8 on the 10-year yield. A while ago, I posted this on the TLT. This was October 21st, and I even shared the chart, I believe, on YouTube at the time. And really what I was showing here was the rate of change, the 1 week rate of change. And I was pointing out that, it was down 4.99% on the week, which is its worst week of the entire year. And when you go back through history and you say, well, when have we had a week that bad before? Well, that was October. Well, what happened after? We saw a pretty nice rally. So it was kind of like a capitulatory move before, rolling up and then eventually rolling back down. And if I give you the updated chart, well, what happened? Well, we had that big kind of capitulatory week, the largest down week in a long time after already moving down. And then we bounced up around 10% so far on the TLT. So I just wanted to call out, we are still in an overall downtrend. However, if the 10-year yield is going to be backing off a little bit further, this could give us a little bit more movement to the upside in the TLT. And other various, I'm just using TLT as the proxy right now, but there's other vehicles that you can use as well. Also, October 23rd, we talked about this capitulatory type move of the new lows in the NASDAQ. And, I like looking at, various indicators to see, when we might hit a capitulatory state where we might see a bounce. And I wanted to call out here, we were 600 new lows while the market was kind of coming off, it's, multi-month down run, which was down about 10%. And I look back to the left of my screen. I said, well, last time we actually went down 10%. We had this kind of capitulatory move here, and then we started rallying a lot. So what happened on the updated chart? Well, you can see we had a couple of days with some more new lows, but this day, when we got a little bit lower here, just a couple of days, a little bit lower, but we had less new lows. So that right there was a positive divergence. And you can see just a very short little move here, and boom, we really started rallying off those moves. But, this is, looking back in hindsight, I mean, it wasn't at the time that we pointed it out, but now I want to call out what I'm starting to see right now in the markets. So if I take a look here, this is a bunch of different index products. On my left-hand side, we have NASDAQ, NYSE, NASDAQ 100, Dow Jones, S&P 100, 1500, 400, which is mid caps, small caps, and the S&P 500. Okay. The lines on the screen, those are the percent of stocks that are above the 20-day moving average. So it's a short-term moving average, but when we have a large percentage of stocks below, for example, the S&P 500 below the 20-day moving average, what happens? Well, typically when it's like 10%-ish, we start to see a bounce potentially, right? Things have kind of capitulated, and we talked about this when? Well, we talked about it then, right? Well, now I'm calling it out because, well, where are we? Well, S&P 500, 84% of the stocks in the S&P 500 are now above their 20-day moving average, okay? S&P 600, 79%. You can see over here, the mid caps. Some of the bigger ones is the SP 100. You have 83% of the stocks. The Dow Jones, there's only 30 stocks, but 83% of those. 84% of the stocks in the NASDAQ 100, which makes sense because tech heavy, and we've seen tech stocks really outperform. So it's going into that kind of overbought condition. It doesn't mean that it can't stay there, but just notice that when we've gotten there before, it kind of came back off and it goes back up and it kind of rotates and oscillates back and forth from being overextended, then they consolidate or come down, and then they move back up and so forth. So we're kind of in that overbought condition. If I look at the NYSE McClellan oscillator using the traditional calculation over here, I look back throughout history here, that I've marked out and talked about on every single time it's happened on this show about these negative divergences, but also positive divergences. Don't believe me? Go watch the show, right? We talked about the positive divergence here. Price action was going lower. What was the internals telling us? The internals were strengthening, giving us insight to a potential rally. And, well, we rallied. Well, the last negative divergence, we talked about price contracting very, very tightly here, but yet the internals, they were weakening, which gave us indication of a potential move to the downside. And, well, we have a current divergence building out as it stands. We had this tick down a little bit, so we have a high, a lower high, we have a high, and a higher high. So price action's moving forward. Internals, they're weakening, and it's above that 150 kind of overbought condition line. So we'll see here if this thing holds up and continues to break down, or if we see a quicker divergence play out to the downside. Now, I will call out, we have this inverse head and shoulders on the price action, so even a back test to just bring price down a little bit could also be an option, but you never know, we could still very well bounce from those levels, but the divergence is there and it is building. What else am I seeing? Well, the NASDAQ composite, the bullish percent index, the RSI, it's moving more into that overbought condition. Okay, last time we talked about it in oversold condition with a positive divergence that led to a nice rally. Where are we now? We're moving into that overbought condition. So it's something to be aware of, okay? This doesn't mean tomorrow market down millions of dollars, right? That's not what this means. I'm trying to give you data that I'm seeing to be ahead and be prepared for the next move, just like we prepared ourselves for a potential rally. Well, now we're preparing ourselves for a potential pullback or consolidation in the near future. So I don't want you to be surprised if that were to happen. The bullish percent index for the New York Stock Exchange in overbought conditions, that kind of lines up here with the NYSE McClellan oscillator being in a negative divergence. So that's, a couple ideals lining up. BPSPX chart moving in that overbought condition at 79 reading on that RSI, but the index itself, it's not like, up at 80. It's not crazy, but it's up at 60 and the RSI is up there. So potentially watch for a negative divergence to form, which would look like this. It would pull back, it would go higher. By this would pull back and go lower. We'd have a negative divergence right there. And that would be a good thing to see from a more, a better ideal in your favor for a potential move to the downside. If you took a look at S&P 500 technology bullish percent index, so this is the tech sector, that was obviously a one heck of a strong move right back up into that 80 territory. You can see the negative divergence here as price, the bullish percent index was moving higher. This RSI was giving us a negative divergence, and that led to boom, 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 that kind of correction in price. We also talked about the bullish divergence right there as price, boom, lower, higher low. Internals told us that we can potentially move higher. We did, and now we're moving back into that overbought state. The Dow Jones Industrial Average is moving into that overbought state. This is a little bit more choppy as there's only 30 names there. And then the energy sector, I wanted to call out that this is pulling down, and we actually have ourselves a bullish divergence forming in the energy sector. That could be something interesting to watch here. Maybe perhaps energy names get a little bit of relief after they've kind of fell pretty hard. So maybe they have to bounce, or maybe they have to consolidate here. Let's take a look at some new gamma exposure levels going into tomorrow, which happens to be a expiration or an option expiration day. So option expiration days, they can be a lot of chop back and forth, so just be careful of that, and you might get some wild willy move towards the end of the day. I've seen that happen multiple times. Just understand that it is an option expiration, so we'll get some new gamma levels here, see how everything takes place. But as it stands, we are still outside of the weekly expected move, and that is down there at 44.80 for the SPX. Local resistance is still there at 45.15, and you can see 4,500 is a local support and one of the larger gamma levels that have been kind of just pinning this market here. You can just see multiple times it's kind of just going back and forth. So, if we push further and break from it, we come out to 45.15 and potentially even higher. The big call wall now is at 45.50. So if we get some crazy squeeze outside of the daily expected move, perhaps that could be a level to pay close attention to. If we start breaking below 4,500 with some volume to support the move, start looking for a reconnect of that daily expected move, which is also in confluence with the weekly expected move there too as well. Gamma flip levels at 44.20 now. Yesterday it was at 44.10. So we're at 44.20 for the gamma flip level. So that means as price is above it, boom, boom, we are in positive gamma territory. So as price pulls back, dealers look to buy. And as price moves up, dealers look to sell. Volatility is typically compressed. And you can see that here. So we're kind of pinned between these, higher gamma levels and above this gamma flip level. Price action has been kind of just acting pin. So we'll see if this 4,500 pin unwinds here in the very near future as kind of just we're building up pressure here. If you take a look at the SPY, here are the key levels on the SPY going into tomorrow as far as the daily expected moves. We're still above that week to date anchored VWAP. We pulled down almost to it, but we could not quite make it as the market kind of just rallied itself a little bit up. Still above an inclining 5-day moving average too, and the month to date anchored VWAP there as well outside of the week to date. If you want these levels, you can screenshot this, or you can just download the chart deck to go over some of these charts yourself in a higher definition. Going into tomorrow, like I said, we have VIX expiration we talked about yesterday. That was Wednesday. Today was just the last day to trade the settled standard AM settled equity index options. Tomorrow is the bigger OPEX. Now going into tomorrow, any more macro events? We just got a lot of Fed speak, and then we have building permits at 5:30. So not too much going on at all, just a bunch of Fed talk. So we'll see kind of just how the day progresses on OPEX. That's all I got for you on today's episode, everybody. Hope it helped out. See you later.